How you doing?
I'm good, Owen. How you doing, mate?
Good. Thanks for being patient with me, mate, as I arrived late to today's recording. And thanks to everyone that's already joined us in the chat for this monthly update. I really appreciate your time on a Monday. So, how have your lives been going every Monday, Mitch?
What's that? Sorry, you
How have
cut
your
it.
how have your lives been going every Monday?
I think it's been going well. I mean, it's. I don't know how you do it every Thursday, talking to yourself. That's the challenging bit that I find. I see. I like doing a live when there's someone else here. It's quite. It's nice. You get to bounce off them, etc. Talking to yourself is difficult. I
Yeah, it
find.
can be.
How do you go on a Thursday doing it?
Maybe it says something about the person that can do it so easily. I like them. I love them. So I've been doing it now for probably 4 years. So for me, it's like pretty much second nature. But I take your point. It is different. It's hard to bounce off people's energy. But fortunately, everyone does come with good questions and those types of things. So it kind of keeps the ball rolling.
Yeah,
Um,
the more questions, the easier it is.
Absolutely. And you get more, I guess, like inside jokes as time goes on. So that helps. But today we're talking about Rask Invest and Rask Core for members who follow in their own brokerage account. We've got a fair bit to talk about, including performance and these types of things. So I'll maybe do the disclaimer now rather than um, wait for any longer. So if you do hear any information that we deliver today, it's strictly general in nature. Because we don't know your needs, goals, or objectives, or even if you think that you've given them to us, we don't take those into account when we answer questions or when we deliver the information here today. So it's really important that you, pardon me, speak to a licensed and trusted financial planner. Pardon me, what a time to lose my voice. I'll just have some coffee. Sorry, Mitch. Um, Please speak to a licensed and trusted financial planner before acting on the information. And we do also have a PDS and TMD, which is available on the shiny new Rask Invest website, which I'll bring up now. And from there, you can make an informed decision about whether or not you choose to invest with us. And we would say, even though it's a legal obligation for us to say to come in here and have a look at it, I just think if you've taken the time to read the PDS, you're probably the type of investor that we want to deal with because you're the type of person that's a bit more discerning. You really do want to know where your money is going, and you're willing to buy into the kind of the mission that we're on, rather than just say investing with another fund manager that just appears in your statement or something like this. So you can find all the information on the new RAS website. It's just here. The TMD is very valuable too because it just helps you answer the questions like, is this portfolio right for me, or which one should I select? You can come in here and you can just have a look and see what the objective is, and so on and so forth. These will be updated in the next few weeks as we have some more updates for you. Today, we're going to be talking about performance since inception. So it's also really important that when you look at our performance, that you make sure that you remember that past performance is not always indicative of future performance. I think the real reason that we have this disclaimer in finance is because a lot of the historical returns that you would see when you see an investment or financial professional, they would come from mainly from the stock market and one-on-one shares. So it would be, whether you buy BHP or sell ANZ or whatever. And what that basically meant was that the future returns that you get, unless that fund manager or investment professional was following a very distinct investment process, the future is never going to look like the past. It's more different now because of ETFs and the way people invest in diversified core portfolios, that they are somewhat more predictable, in my opinion. But for example, what we've seen over the past year with like the entire stock market going up 30% or something like that, that is not at all a reliable expectation for the future. So just keep that in mind when you do look at portfolio performance of us or anyone else. Just keep that in mind. And even to be honest, 30-year track records. At the moment, since the early 90s, we've seen interest rates falling across the world, globalization, technology, and these types of things. Whether or not that is a repeatable trend into the next 30 years is up for debate. So, Mitchell, now that I've done a long-winded disclaimer and almost choked on my coffee before, what's been making news with Rask Invest? Like, what are the questions that people are coming to you with?
Well, the past month of Rask Invest was probably our most uh, let's say, definitely had the most amount of stories and narrative, etc., in the media. As far there was a little event happening in the US
Yep.
over the last few weeks, which certainly have caught lots of people's attention, caught headlines in the mainstream media, financial media, etc. But what do they actually mean for investors and for investors in Rask Invest? That conversation has been had actually fewer times than I would have expected, which I think is wonderful, because that actually really talks to the levels of knowledge and education that our investors have. So I've definitely been pulling up the Vanguard historical index charts a lot recently, and if you've not seen those, you just Google the Vanguard index tool, and the beauty of it is you can actually overlay different like presidency campaigns and things like that throughout history, presidents, prime ministers, etc. And you can see what impact those things actually do have on financial markets. Now, because of the volatility that we've seen around the market, a lot of people have been talking about, is now a good time for lump sum investing versus dollar cost averaging. I think we'll go into that a little bit later. I know it's a topic we've covered a lot recently, but it's always present, because the thing about these graphs is we're always at the hard right edge of that graph, and so the next bit's blank. We don't actually know what's coming down the track, and so that does make a lot of people unsettled. Owen's got that awesome Vanguard chart up here now, which is really, really cool. So a lot of conversations about that. Post-election, a lot of conversations about satellite positions as well. So, of course, there's a little company called Tesla that comes up in conversations a lot more recently than it has done historically, given old mate Elon Musk has played the election like a fiddle and has ended up in basically embedded in the White House. We'll see how long that lasts for. I know, I've heard the saying that no matter if it's businesses, relationships, both professional and personally, with Mr. Trump, that inevitably they end up coming unstuck. So let's see how long he hangs out there for. But it's a great segue into conversations about core and satellite that I've been having with people. I often start the conversation about core and satellite along the lines of, just because you could doesn't always mean you should. But this has come up numerous times.
It's actually a really good point. I put something on, speaking of Elon Musk, I put something on Twitter the other day. I don't go on very often.
I was going to say, you're back on.
It was probably a relapse, and I just put something on here the other day just to share the latest performance. But I basically just said that one of the benefits of having a core portfolio done for you, in effect, is that you can then be more, I guess, liberal with your satellite allocations. So being able to, for example, have a core and satellite portfolio set up means that your satellite can be more, well, I'm just going to take, the 10 highest conviction positions I have and just go with that. Or I'm just going to make a bit of a mess of my satellite, like, and have 30 positions, but they're going to be really small, because in the back of your mind that you've got this core portfolio, which is, professional, it's diversified, it's low cost, it's rebalancing, which effectively gives you more reign with your satellites. And I think the big thing that it does for me, at least, Mitch, I don't know if you think this way, but the big thing that it does for me is it allows me to act more objectively. So when you've got your entire portfolio in individual stocks or, really actively managed strategies, you do have to be on top of it more. Like, the further you go down the market cap spectrum, the more sensitive you should be to things. So, if you're a micro cap investor on the stock exchange, well, you want to make sure that you are keeping up to date with every single announcement, even if it's like a director change of shareholding. You
Yeah,
need to know.
I wouldn't do it unless I really enjoyed it
Yeah,
personally. As in,
yeah,
I think that's dedicating that amount of time to it, especially for people who have got careers, families, etc. To do this well, I know analysts who spend their every waking moment thinking about, they print off annual reports to take them on holidays with them.
yeah.
Those kinds of people, and they're the ones that tend to be successful at it. And unless you're bringing that to the table, I just don't think going off a hunch is good enough. It's your own personal money as well. You should be. I think most people actually overcomplicate it and are better off just going call. They
Yeah, yeah,
probably get better results if they just went call.
absolutely. I think most of those analysts that have their head in the annual reports, I'd say 95% of them aren't good investors. And I know a fair few of them now. And I can tell you that there's only, even doing the podcast for 6 years, and then before that, profiling investors for 5 years before that, I can tell you I've probably only come across 5, maybe 10 that I would trust with my money.
What are the characteristics, Owen, of those people who those 5 or 10? Let's not. We don't need to
Okay.
name
I'll
them.
give you
But
I'll give you
the
some names. Yeah,
characteristics.
I'll give you some names.
Yeah. Okay.
Like a good one is like Steve Johnson from Forager Funds. Caught up with him the other day. Um, he's been through the ringer, like with his business and with the way he invests. So it was deep value when he was back at Intelligent Investor. Then it transitioned a few years ago to more growth at a reasonable price, which is kind of trendy at the moment. But that's where he's always kind of been laying his investment wares. And I think that the thing about Steve is he's very honest and genuine in his approach. I think this is me talking about like individual investors, right? I think if you adopt more factor-based investing, I still think of that as an active investment decision that you would make in a portfolio. Like if you went with like, for example, we had Scott Bennett appear on our Australian Investors podcast recently. He's from Invesco. And when you invest with Invesco, you don't actually get Scott, you get their systematic investment process, which is really just formulas and quantitative strategies. So even though that's an active strategy, that's not necessarily what I mean by there's only like a few individuals that actually pull the trigger on investments. I think Joe Mager really stood out as probably Australia's best investor when he was at Lake House Capital and before that at the Motley Fool. And then obviously he now runs Seaplane Ventures as a VC. And he's similar to Steve in that he's very competitive. He likes to own his craft and do really well at the thing that he does really well at. Like a lot of investors spend time trying to be everything to everyone. And I think that those two gents have done a really good job of just sticking to their knitting time and time again. Even when times get really tough. Like if you look at, I'll give you an example of this. If you look at Lake House went through the similar process after Joe left with Donnie Buchanan. And Donnie's a fantastic investor, country boy at heart, which is another thing that I love. But if you look at, I think it was their small companies fund. If you just look at the deviation in the results, so look at that drawdown from what I don't even know. So that was 196% was the return of the fund, to then down to 50%.
That's a lot to stomach for an investor, for a fund manager, for a business.
Yeah. So at that time, most fund managers would stick their head in the sand and probably change strategy. Like they probably would have gone more cash, gone to different types of stocks, away from Pro Medicus, away from Ordinate and those types of investments. But they kind of stuck with it. And that's kind of the journey that you get on the way up. And so I'm looking for investors that stick to their knitting, even if it means pain for them. And so that's one of the characteristics. But, when you invest I'll show you now, I'll come back to that chart in a sec. When you look at the performance of our portfolios for the month, obviously a month's not a very long time. So you look at it and you see, even during a presidential election, I'll zoom right in so we can see it. Maybe blow that Terra portfolio up a bit. When you look at the returns, like the dispersion in the returns is not very significant. So the worst performer, which is probably the safest ETF we've got, which is the IAF bond ETF, was negative. Rates obviously didn't fall in Australia during the month of October. And then here, when you go through to the to Martian, it's the 70-30 strategy. VAS, the Australian shares portfolio, down 0.33. The best was 1.33, which is US shares in US dollars. Coming down to Jupiter, again, IVV and VAS. And what you get from these is not really like, you don't get that wild dispersion in the returns. You're never going to see us draw down like Lake House would as a single sector fund, but maybe you put Lake House as one of like the tiny little slithers in here. And that's what I mean by, like, you could have Lake House. If you had the core in a portfolio like this, you could still have Lake House. You could still have Forager. Even though I quite like the intelligent investor strategies, the current ones with Nathan Bell, to be honest. I think Nathan's got a lot of the similar values that that both Steve and Joe have. They're both, really good investors, and I think Nathan's in that category too, just a little bit different about how he goes about it. I think, to continue the theme on like ex-newsletter writers becoming fund managers, I think Matt Joss from Maven Funds is quite good too. I think he's higher octane than all of them. But I think that those types of investors could slot in neatly alongside something like this. But this is for huge uncertainty around interest rates, both in Australia and globally, uncertainty around the currency, and a US presidential election that they say everyone's like the most contentious of all time. But like this one in particular was quite interesting, I think it's fair to say. And if you think about like peak uncertainty with markets being high, the portfolios, when you invest like this, give you a great sense of comfort because you know that you've covered all bases. Drew often says on the Investors Podcast that you don't prepare for a future, like you don't prepare for Kamala Harris to win or Trump. You prepare for any future so that no matter what happens, like we've got Tesla in IVV. But if Kamala won, we'd also have bonds and US dollars and would have benefited that way. Mitch, I wasn't 100% sure if my figures were correct on this average balance I just wanted to kind of show everyone a little bit behind the scenes.
It's if you're rounding up, it's there.
Yeah.
It's actually 67,000.
Yeah,
Is the average
67,000.
balance. There you go.
I wasn't sure because based on the latest numbers, I wasn't sure if it was already at 70. But what we're starting to see, everyone, is we've seen this now for the last month or two, which is that existing investors are adding more money, still overwhelmingly adding more money to Rask Invest than new investors. And what we're finding is that most new investors are coming, even if they're people of substantial means, invest $20,000 with us with a expectation that they'll get to hundreds of thousands of dollars in the pretty near future. And so we're starting to see our average balance of people that invest with us and families who invest with us rise through time, which is really, really impressive. And that's when you look at a diversified investment company like this, like ours, you would see something like this. Whereas if you might see like a Lake House or a Forager or one of those other ones we just mentioned, you might see ups and downs, like dramatic peaks and troughs. But when people treat it like a sensible long-term investment and the performance matches that, you get this kind of much smoother shape. And if you come back to the disclaimer that I said at the top of the show about performance, past performance is not indicative of future performance. This is why when you invest the way that we do, that comment and that disclaimer is less relevant. It's still relevant, but it's less relevant through time. Because you are diversified, because the dispersion of returns isn't as significant. And that's what you see up here. Mitch, I don't know if you want to add anything else. I know you put out the letter for everyone last week, but is there anything else you wanted to add on this?
I think, Owen, for our investors, you've hit an important point. The majority of people are coming in at 20,000, 30,000, 40,000. And they might be SMSFs, family trusts, companies, individuals. But through our conversations, they do indicate they have more funds, significantly more funds to add to the portfolios. So what you're seeing is, really we pretty much opened our doors in April to outside funds, people to invest in the portfolios. Those people in April, May, June, July, what we've seen now in the following months is they've been able to watch and see the portfolio unfold. They've added small amounts of funds to their portfolio just to see what triggers transactions, etc., how it works, and then all of a sudden, bang, 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 they just go those larger sums come in relatively consistently, and so it's really good to see, because that to me indicates the health of our. I've said this to you before, Owen, actually quite a few times. The health of our investor base, really, and their engagement. The great display of that is the confidence to add additional funds to the portfolio. So
Absolutely.
what I have seen a lot recently actually is people, and this is from a number of conversations that I've had, people are now looking to do their contributions towards the end of the month, and even the end of the end of the quarter, and that's to ensure that these are people who are growing their balances, to ensure that they sweep up, that all the dividends that have been paid for that quarter are collected collected up with the new cash they've put in, and that's all used to buy new investments into their portfolio. Because we do have a few triggers, or rules, I should say, in these portfolios, that when you add funds, it doesn't mean we immediately go out there and buy investments for you. When you add funds, cash is a percentage in our portfolio. So when you add money, what we look at is the percentage of your cash balance compared to the model that you've chosen. Say Jupiter, for example, it's 5%. You need to add funds and have that exceed, say, 7%. And then that way you're out of line with the model. That triggers purchases. So people might be, so you receive some dividends. No single dividend alone on its own is going to bump that portfolio into the realm where we need to trigger transactions. So if you want it all swept up to make the most out of the brokerage, you'll wait until those distributions have been paid, and then which is once a quarter, you'll add then your funds. All that cash combined will then go into rebalancing your portfolio back in line with the model. So that's what I'm actually seeing that more and more, because the month of October was a distribution month. So all of our ETFs paid distributions then. And so then I saw at the end of October, lots of new funds coming into people's accounts to ensure that they make the most out of their brokerage. Oh, and I've noticed something, I don't know if you have, but the chat system that we use here is awfully quiet. So I jumped across and onto another tab, and I can see that the comments are coming through, but just not on our tab. So right. I'll duck back and forth just to make sure that I capture all of the comments as they're coming through.
Yeah, if you can, that'd be great. So just for everyone's purpose, the software that Mitch and I use to bring you these live shows has just gone through a massive redevelopment, and I was scrambling trying before we went live to try and get everything sorted, and it's a bit all over the shop. So if you are sending comments through on YouTube, please keep them coming if Mitch can find them, because on our side it looks like there's nothing. So please keep the questions coming in. One of the things I wanted to talk about, and this is more to share with everyone, like what you've done by investing with us, even if you're part of Rask Core, what you've done by investing with us is you've been here on the ground floor to help us grow this. And what we've done is we've struck a partnership with InvestSmart to bring portfolios that are sensible and long-term focused. But this is only the first iteration of what is likely to come over years and years and years to come. And so a good example of this is like what we want to work on next, how we want to improve the platform that you invest with us through. One of the things as part of Rask's really big rebranding and the way we deliver our business now If you haven't already visited the website this month, you can start to see this. Rask Core is currently being updated, by the way. One of the things that we're doing is we're moving further into the heart of wealth. So that doesn't necessarily mean, just which stocks and what have you want, but it also means something deeper than that. It means the advice that you receive, how you get advice, at which stage of life do you want what type of advice. And so as we go on that journey together, what's going to happen with Rask Invest specifically, as you know it, is that it will evolve to cater to different needs. And so one of the needs that we have already identified, and Mitchell and I have talked about this a lot, is investing for children. So that's coming. I was just messaging Mitchell about it this morning. That's coming very soon, and in the beginning, we're going to. With this is our plan, just so you're aware, is we're going to limit that to a certain number of people and investors, and that will be limited to you who have already invested with us, just so we can make sure that the strategy is right, the offering is right, and also that we get the right types of people that want to invest for their children or grandchildren or family with us. But you can see that kind of taking shape now after a year of work. All of this is coming together. So we've currently got the 3 strategies. Mitchell and I have already discussed, and the investment committee has already approved our children's strategy. And the next strategy beyond that is quite interesting too. And that's going to be quite different from the current strategies of Jupiter, Martian, and Terra. It will most likely be an all growth strategy, knowing that many of our investors currently and in the future will hold their own cash, will have property, will have a business. You'll have money in an offset account. And all you want from us is just the highest growth strategy, even if that means higher risk. So that's all you want from us. So that's something that's also on the radar in the very near future, and as well as a bunch of other improvements that we see coming. Mitchell, have I captured that correctly?
Yeah, I think so. Yeah, absolutely. So I should be sending off the emails this afternoon to get our kids portfolio up and running that we're calling Luna. And I think people have heard me bang on about it quite a bit, but I want a lower. We want a lower entry point for the portfolio. We want higher exposure to international assets and Australian assets, simply because international assets are more geared towards growth and not dividends. And we want to be very mindful in rebalancing this portfolio to the point where we're not really triggering unnecessary CGT events, because investments in kids' names come at a higher, the income comes at a much higher tax rate. So I think we've wanted to put a lot of care and effort in thought into the portfolio, simply because you can invest for kids in kids' names in our existing portfolios. There are other services out there where you can do the same, but it's not how I would invest for my kid. And that's what we wanted to do. It's a balanced growth, a standard high growth portfolio. Doesn't take into consideration those major hurdles for investing for kids, or those major considerations, which are tax and the time frame. So this is something that I wanted specifically designed that I would do for a kid. And not just a bog standard portfolio with the ability to apply for it in a kid's name. That's the big difference.
Absolutely. And we also recognize on the all growth perspective that a lot of you have followed Rask for many years, since like many moons ago, when you really appreciated our more active style of investing, which is something that I still love. But also our ability to work with active fund managers may be something that appeals to you. So this is something that we are looking at further as well, in terms of how do we bring really great fund managers to you, and allow you to have more control as well in that process. So These are all changes that are underway, and I think, long story short, a year from now, what you see from both Rask and Rask Invest specifically is going to change in a big way. Now, I do have a slide here of performance, which I'll bring up in just a moment, if I can show you this here. So, since inception, figures are slightly skewed, but the 6 monthly figure is pretty good in terms of understanding. This is until 30th of June. Sorry, not 30th June, 31st October. We launched the portfolios in late March, so that's why it's always a little bit different between since inception 6 months. But when we started on this journey, you may remember we had goals for each strategy, and those goals were quite conservative. And I think we're starting to see that work now. I think the last 6 months and 12 months has been very, very good for financial markets generally. So I don't expect that always to continue. But you can start to see that playing out now in our 6 monthly numbers. If I can, or if we can produce an 8 to 10% return from Jupiter over the long term, I think that's a wonderful outcome, considering it would also have defensive assets in there and it'd be diversified and these types of things. So all of those things considered, I think we're on a trajectory to achieve that, but we've got to make sure that we capture some of the upside, enough of the upside, so that when there is a drawdown, and we try and protect on the downside a little bit, we can balance that as well. A couple of the things that are worth noting is that obviously in the United States, we've had an interest rate decision, interest rates cut. We've had a new president come in who is very pro-business, and that has broader implications across the strategy. Now, our portfolios have always been positioned for US growth. So that's always been, from day one, the key for us is, notice, I don't really like the phrase US exceptionalism, but I mean, it's pretty evident that that's what's happened over the last, say, few decades. We've always been long duration bonds for about the last 2 or 3 years. So what that basically means is that if interest rates fall, our portfolios will benefit. So we can start to see that already across the portfolio. The third element that you should expect to see from us going forward, and the thing we'll probably talk about more in early 2025, probably till I'm guessing about mid 2025, is how we use our cash and how we use our defensive assets. Because if interest rates do start to fall in Australia as they're expected to, that's an expectation, not necessarily a fact. And in the United States, if interest rates continue to fall, what will likely happen is we will start to think forward about how we use our cash and our bonds to rotate into other asset classes or similar asset classes, but are protected in other ways. So there will become a point in time where having long duration bonds, I would imagine, like VBND or IAF, won't be suitable for the portfolios, at least in their current holdings, at their current size. So, for example, we may move into credit style products, or maybe we move into floating rates, or maybe we move into what's called short duration, which is not the same as going short, but it's short duration, which would be like treasury bills and short-term government bonds. And in that way, we wouldn't feel the pain if interest rates do inevitably start to rise again. One of the interesting conversations that I had last week was a discussion about stagflation. And this is kind of like, if you think of Nassim Taleb's Black Swan events. So if you haven't read those books or seen him talk, that's fine. But basically what it means is, like, negative events can be really bad, can be way worse than the good times. And these events do happen in certain markets and with certain, I guess, data sets. But the idea is that if we move into a period of stagflation, what would do well and how would we protect portfolios is a real interesting conversation. So basically what it means is that inflation wouldn't necessarily, basically your portfolio and your wealth is going backwards. Inflation could be high, but you're still not moving forward like we have in the last couple of years. Like, inflation's been high in the last 2 years, but stock markets have gone up. Interest rates have gone up. Everything's gone up. But what happens if we had high inflation and low growth or no growth? That's a real issue for people. And so the current consensus is, like, what will happen in the United States if Donald Trump comes in swinging and forces productivity and forces inflation through the system. So say, for example, he comes in and he says, I'm going to spend $10 trillion making America great again, but the system can't handle that. And then at the same time, or the government in the United States wants to remove, foreign workers, which would further increase inflation because those are typically a source of lower inflation and of productivity. And so instantly you have a huge amount of artificial inflation with no growth. And that presents real problems for people that allocate money because then you don't necessarily know. So we would have to think more broadly about, well, what asset classes give us exposure to consistent drivers of real returns. That's returns in excess of inflation. So I know this is all kind of like gobbledygook, but basically what I mean to say is that early 2025, don't be surprised if we start to make some slight changes with our cash positioning as we see things changing, not just in the United States, but abroad, because we don't know exactly what is coming, but as it stands, US is dropping interest rates, which will boost productivity. New president in removes uncertainty, pro-business. That has already had an impact of driving the currency up. So if we look here, it's already had an impact. You can't really see it right down the very bottom here, but the expectations are that we're going to have some volatility in the currency, and that will force us to do something with our portfolio and eventually do something with our cash. I'll keep you updated as more of that comes to hand, and everything that we do has to go before the investment committee anyway. But I just wanted to air that because there's an episode coming out on the Australian Investors podcast which might spook people, Mitch. Just want you to know that it's not terrible and there are ways that we will deal with it.
Is that the one with our friend Billy?
Yes.
Yeah,
so,
right.
yeah. There's Billy Long from Global X. He was talking about US tech stocks and under President Trump, what would likely happen in the scenario where there's a lot of investment into different parts of US infrastructure. Obviously, Elon Musk getting into the White House, quote unquote, is all about securing Tesla's future and SpaceX's contracts with the government and these types of things. But what does that actually mean in practice? Well, it doesn't mean that he's made a lot of commitments to certain parties that is going to stimulate a significant amount of investment in the United States itself that could have adverse consequences from a macroeconomics perspective. Yeah.
Excellent. Owen, talk us about, you put up the currency just before.
Mm-hmm.
Can you talk about the impact then on our US holdings, IVV, but we also hold IHVV, which doesn't get too much of a mention. It's a 10% position, say, in Jupiter. So can you maybe just talk a bit about why we hold both?
Yeah, sure. So it's about not preparing for a given future. And so when we started Rask Invest not too long ago, you might remember, if I bring this currency back up, you might remember, where were we? We would have been around here when we started the portfolios. And so when we were building these portfolios, we were actively mindful that over time, like statistically, we're in a bit of a decline for the Australian dollar. But that might not always be the case. We might not always see that, the Australian dollar is weak against the US. If you go back far enough, many people will know the Australian dollar basically hit parity, and was above. So that's very uncommon in this long-term history of the Australian dollar since floating. Since floating, the Australian dollar has averaged around low 70s. Over the last 20 years to 30 years, it's been slightly under 70 cents. And so if you look at that, we're kind of, we're slightly below that. So when we effectively switched on the portfolios, we had a slight currency hedge position. And that was more just to protect against the downside. There have been periods in the United States where if you were a foreign investor, like for example from Australia, where the United States stock market has gone up significantly, so say like 30 or 40% over a decade, but you've actually had negative returns because of the currency, such as in the 2000s. So you never want to be in a situation where Even though over the long term the stock market goes up, you don't ever want to be at an extreme moment. I think, in my experience, Mitch, in dealing with investors and speaking with fund managers and CEOs and these types of things, it seems like the most prudent strategies of all are the low turnover strategies. So the strategies that don't require us to make a lot of decisions, other than when it's really obvious that something is out of whack. And what I mean by that, if you look at like the way Warren Buffett invests, he's often slow to do anything. And then during the GFC, he'll go and buy something because all of a sudden he's built up and he's done nothing for a while. And then he's seen an excess in the system. So as in this case, it was an excess of fear, and he's made massive decisions to invest. Same with like the mid 2000s where he started to mid 2010s where he started to allocate into Apple shares very heavily. You could see that he recognized that, and so it's basically just about being prudent through time. It's not necessarily trying to be specifically correct, but generally right over time. And for me, we talked with BetaShares about this not too long ago. For me, having an always-on small position in a currency-hedged US S&P 500 ETF makes sense statistically, emotionally, but like behaviorally, it makes sense to have a small amount in there. And particularly when the currency is, as we know, below average. There's no guarantee the Australian dollar reverts to that average anytime soon. But if it does, then our position would be somewhat protected. So I think like BetaShares, if you look at their research, I think Cameron was saying that there's a case to be made that for your global shares, you should always have 30% of your portfolio, of your global allocation, currency hedged. Now, depending on the strategy, we probably wouldn't be at that, but I think it's prudent to have a little bit there, Mitch, rather than try and predict where it's going to go. Just have a little bit that's always on that we can slightly buffer around. It's not a
portfolio, like the portfolio of least regret.
That's it. Yeah. And, we're not necessarily out here to say that, our portfolios are going to be the very best, right? I probably don't want that to be the case, because if we try and shoot for the stars, this is the old problem with funds management, is if you try and shoot for the stars, you might actually hit them. And then the next year, you're completely off the mark and you've got a bigger portfolio and you've lost more people money. And that's the old, issue with funds management, is that the best years of investing in a fund manager are early, when there's not many investors there and the performance isn't that good. And that comes back to that disclaimer.
And again, a lot of people don't get that, because they will wait to see 5-year numbers or longer, and then they naturally, the bias is to go to a website such as Morningstar, search for the the asset class you want exposure to, and just order the table by 5-year returns.
Yeah, and the same thing will, but to a lesser extent, happen with us, Mitch. If you look at, say if you take the 6-month returns, if you jumped onto Rask right now, you jumped onto our website and you saw Jupiter 7.9%. Well, if I just multiply that by 2, 15, 16% a year, I'll take that. If someone jumped on and thought that, they're not getting the 8% that happened in 6 months. They're going to get the whatever comes next. And from my experience, that may not necessarily be something that happens in the next 12 months. So I don't have a way to tell you for sure whether or not that will happen. But I would just say, generally speaking, that would be a big mistake. And fortunately, we'll be able to avoid some of that thanks to our diversified portfolios in nature. But I think that through time, you start to see that strategies such as ours, like say after 10 years or 5 years, what you start to see is these types of strategies rise to the top of the performance in the league tables anyway, because all the active funds start to die. So there's a massive survivorship bias that happens, and everyone searches for like the next Magellan or whatever, and the next this or the next that. And they get it for a few years, they do all right, and then eventually it mean reverts, but it mean reverts minus costs and a bunch of other things. And that's why you'll end up with, I hope, over 20 years, a strategy that outperforms 99% of fund managers, like actively managed. I'm not saying that that's not a forecast. I don't know if we'll do that. Might not even be here in 20 years, But the reality is that if you invest sensibly for a long period of time and you're consistent in your knitting, I think that you'll end up with a really good product.
That makes sense.
Yeah. With it, sorry, go on, Mitch.
It's very unusual to be doing this without seeing our comments come through. So far though, to my knowledge, it doesn't look like we've had too many come through. So I'm just going to refresh here just to make sure I've not missed anything.
Yeah. If you do have any questions, now's the time, because we do the only other real update that I have for you is that the Rask core portfolios are being pages and websites being updated now as we speak. Basically, I was getting questions about it before we're coming on air. The other thing is stay tuned for the Luna portfolio launch. So that will come up soon. Existing investors will know first. What will likely happen is once you, sorry, 1 second. Once you log in, just click here. Once you log in, you'll likely see something up the top here where you can create, investment account for your child, and you can select the Luna strategy. So at first, we're restricting it to existing investors who want to invest for their kids. And we know that there are a lot of you, grandkids, kids, nieces, nephews, that sort of stuff. So you'll be prioritized. A big reason why we're not rolling it out more broadly is that every kid's account costs Rask money. And if we just open the floodgates, we could get all types of people in there that aren't necessarily philosophically aligned with us. Another thing to keep in mind is that we do plan on bringing out an all growth strategy. So if you do want something that's a little bit more, I guess, active in the approach, we still use factor strategies, systematic strategies, index strategies, but we can buy shares, we can buy other things in the portfolios. That will likely come. I'm not going to say exactly when, but if I can aim for the first quarter of 2025, that would be perfect.
We have had a question as I jump back across to YouTube to check it out. So, and it's along those lines, Owen, would crypto ever play a role in the portfolio?
So as a general rule, I think cryptocurrency, quote unquote, investing is a bit of a farce. That's not necessarily I'm not necessarily saying that it wouldn't work, because obviously Bitcoin, Ethereum, these types of things have kept going up. But I think it's become obvious that people want that exposure. So I could see it being part of a strategy that is slightly more active and slightly more growth focused. The old phrase of cryptocurrency investors and Bitcoin fanatics was always that get off zero, and basically implying that you should have at least a 1% allocation to this, because if you have a 1% allocation, then at least you've got some upside and the asymmetry on that 1%. So if you have 1% in something that turns out to be 100x, then it makes sense to at least have 1%, even if it's quite risky. So philosophically,
I'd imagine including it into a portfolio, you would increase your MER quite considerably. I've not personally looked at a lot of or any crypto ETFs, but I imagine their MER would have to be high. Like it'd have to be at least 0.5%.
Yeah. Beyond that. So what Mitch is referring to is the fee that you pay for investing in one of those strategies. Mitch is often over 1%. And the reality is that, that's a high fee to pay. But if you've got a diversified portfolio where that's only a couple of percent of your portfolio, if you pay 1% for something like that, and you pay 0.04% for the S&P 500, then you can afford in your fee budget to allocate to something like that. I think if we bring out one of these strategies that we're thinking of bringing out in the new year, it will likely be a higher fee strategy.
It'll have a higher MER, underlying MER for sure. If you're using these more asset class specific or sector specific, etc. ETFs, they just come at a higher cost.
That's right, because we can do things. So say, for example, you come to us and you see that one of our strategies has an underlying fee. So that's the fee of the ETFs and the funds that we select for you of, say, 0.7%, which is in line with the Australian super strategy, versus our current underlying fee, which is about 0.16, which is basically nothing. You'll see a very significant difference. So you would want to make sure that the extra 0.5% that you're paying for the fees of those strategies is that you want to make sure that it makes up for that. And there are other things we can do here, Mitch. So we can incorporate different strategies in our fee bucket that may not have necessarily a management fee like that. So we can balance it and we can choose. It's like paying for anything, right? Like if you go and buy a boat is very expensive. I can tell you that. If you go and buy a boat, you might not be able to afford everything that's the best on that boat, but you might be able to get a decent, engine, but a really good hull, for example. You have to make compromises. And so with a strategy that is more high growth, long-term growth, we will have to make compromises in certain respects, and it's a trade-off there. But that's like any investor would have to make that trade-off.
And someone's mentioned in the comments as well, how would we actually go about, how would you plan to minimize tax consequences in that kid's portfolio? And so what we're referring to there is we can control how often we rebalance the model. And so what we're aiming for here is a portfolio that we have to do little to very, very little to no rebalancing. Yep. And how we do that is by with the mechanics of our accounts. We have the model portfolio, and then the model portfolio is preset, like X% international, X% Australian. Let's just so let's just call it 50-50 if that was the case. And when you add funds in, your actual live account is floating, so that might drift 51-49, split, or 52-48, depending on the market movements. But what we're encouraging, or not encouraging, what we're saying is these portfolios are for kids, for people who are looking to build, to consistently add. And if you're doing that, that money comes in and is allocated at the original split, say the 50-50. So say if something's drifted down to 48, those new funds will be going to that position to bring it back into line and bring the portfolio back into line with the static model. And so that is slow, gradual rebalancing without having to trigger a sale. Yep. Which, if we don't trigger a sale, it means there's no CGT event.
So we've tried. Yeah, good points, Mitch. So we've tried to keep this strategy really simple for kids.
Very simple.
Because that's what. Well, first of all, it's what you want. But second of all, over say 10 years, we would love that 80 or 90% of the transactions that are happening, probably 90% or more, to be honest, of the transactions that are happening on that account is a purchase. I think if we get any more than 1 in every 10 is a sale, I think that may start to erode the efficacy from a tax perspective. But I do want to just hold us up here and just say something that we've had a lot of conversations, and there's been a lot of research and commentary online about this, which is that a lot of people get fixated when they invest for kids on tax. The old cliche, if you go to an accountant's event and someone on stage says, "Who wants to pay more tax?" and there's only one person in the auditorium that puts their hand up, you want to be the person that puts the hand up. Because if you've paid tax, it means that you've made money. And so don't let the tax tail wag the investment dog. And we'll be very clear about that. Like from my financial planning background and understanding, sure, you could have a family trust, which is the most tax efficient, or you could invest in, the lesser income earning parent's name or whatever. And those are great, really common sense strategies. But if you're a horrible investor, it really doesn't matter what you invest in. So make sure that you don't overthink that too much, and you just focus on, well, what am I going to get out of compounding over the next 20 years or 10 years? I think that's a far more important decision than necessarily just focusing straight away on the tax. You can always change, right? You can always start a family trust in 5 years and have 2 different accounts for little Bobby or whatever. It doesn't really matter too much. But like, what are you getting first and foremost? And then, yes, try and do that in a tax effective way, but don't overcomplicate it is what I would say with that. And I think the Luna strategy is just simple, it's elegant, and it will be revealed in the next couple of weeks.
A couple of questions as well, they're popping up, Owen, about switching to the new strategy. So you can switch strategies with our accounts. It does have to be 100%. So 100% from one to the other. If looking to, so that is something that we can and will do for people. Something you can do right now. How we do that is because your account is your standalone account. We sell down just the assets that we need to rebalance the portfolio. So it's not 100% sell and 100% buy of the new portfolio. If there's crossover ETFs, we'll sell what we have to. Someone's mentioned as well, could they do, say, 50-50 with the new potential high growth portfolio, all growth portfolio coming down the track? At the present time, not in the same account. You can do it within the same login, but you would have a separate account, and you'll be able to toggle between the two.
Yeah. So that would be like where Mitch and I showed in the top left-hand corner, where you have like the drop down. So that's what you'll start to see in my Rask Invest login in the future, is you'll see my family trust has a different account as well. And so that will be in there. And we've also, for us personally, we've always had it kind of. We've just set up a bucket company as well. So if you're not familiar with that, you can send us a question or get in touch with our accounting partners.
Yeah, that's a good one. I'm not sure, we haven't spoken too widely about our accounting partners, but if you go on the new Rask website, you can get linked to our accounting partners who, if you ever listen to or watch the Australian Business podcast, you've probably seen the fellas, Daniel and Jordan there. They're fantastic at what they do. And if you ever have questions about, hey, what's the best, most tax efficient structure for me to do this through, that's the type of person you want answering those questions. Yeah. We did have a question come through. Matt has asked, how did you get that cut on your finger?
That's a good one. Yeah, my hair's also standing up because I was using my wherever they are now, my Apple AirPods earlier on. So really, these are the hard-hitting questions we need, Mitch.
I didn't even notice a cut on the finger. There it is. That's yeah. I mean, not quite in the range of some of our guests who have been missing a finger.
Yeah, well, Paul Clitheroe is missing a bit of his finger. I believe Alan Collar is missing a bit of his finger. Something in the water over at InvestSmart.
If your finance professional is not missing a finger, I'm
only 1/10 of the way there. See, if I lose the whole thing, I'm Paul Clitheroe. So no, well, it's it's ironically very similar to Paul. I was out fishing on the weekend, and I caught a fish that had a spike. And let's just say, every day of the week I deal with one of these, and it was going to catch and release, right? And I went to pick it up, and it moved just at the right spot, and it sliced the top of my finger. Had it been, half a centimeter closer, I probably would have been in the hospital. So, such is life when you're on the boat and you're fishing, and that's just what you got to do. But rest assured, everything's fine and everything was safe. And the portfolios are still safe, even though he might be missing a little bit of skin on the finger. So that's a good question, though. I like the hard-hitting ones.
And someone else has asked, did Drew buy the Tesla?
I think that I've lost him, to be honest. I think he's been lost to the diesels. So is that Derek on? Yeah, Derek. He's not one of us, Derek. But we did have a bit of feedback. So if you want to share what you think Drew should do, should he buy? I think it's I don't even know what it is. It's a Toyota of some description, or a Tesla. Let us know, because he needs feedback. He needs a bit of guidance. But yeah, it's an ongoing thing. I think there's a lot of people in our community that drive an electric vehicle, and B, invest in Tesla either directly or through an ETF. And so there's a lot of bias in the community. Not many people own Toyota shares, put it that way. So if they did, I'm sure he'd get a different response. But if you are speaking with an accountant, a good one, and you are thinking of purchasing a car, make sure you ask them about the subsidies or the differences between an electric vehicle and a combustion engine, because it's probably the biggest tax loophole that I've seen in the last 5 years. That's why I used it. I wouldn't have bought the Tesla if it wasn't for that, to be honest. So if you do have the opportunity to catch up with your accountant and they do understand that, really good opportunity to, if you're upgrading your car or even just switching to an electric, especially if you're a business owner, seriously consider it, because there are significant advantages to that from a financial planning perspective that I don't think most financial planners know about, to be honest. So good accountants will know what I'm talking about. Not to lift the lid on it too much, otherwise the ATO might change their ruling. Yeah, go and check it out. So Mitch, a few updates for folks. We'll keep. If you're invested with us, if you're a Rask member, you'll already receive updates over the next month for the Luna strategy. You'll also receive updates for the Rask Core revamp, which is currently underway. You'll also receive updates on how things are going to evolve in that respect around stock research, around ETF research. We've got some ETF research to come out as part of this. So there's a few changes coming. There's also been a lot of chatter, obviously, online with the self-wealth takeovers being put, and people, you might have seen that in our weekend email. If you want to talk to us about doing things like an in-specie transfer, that's where you can transfer shares you already own. So say you already own VAS or IVV and you want to transfer that across to us, let us know. You can use the instant chat function on the website. It's a little bit more, it's a little bit more complicated than just opening.
I can just quickly, whilst we're here, I may as well go through it really quickly.
Sure.
So is it worthwhile transferring? What we do from day one when you open up your account is check your portfolio and see if it aligns with the model. Anything that doesn't align with the model is sold. So should you transfer everything in, should you transfer it to a different broker, etc., you can transfer in the assets that you know we're going to keep. Some people just transfer in everything because they're happy to have their portfolio cleaned out. But we will keep what is in line with the model portfolio. So VAS, IVV, IAF, AAA, VHY, etc. That will remain and if you want to check that, just check in with me. I'm happy to share. And basically, if it's not in the portfolio, it is sold indiscriminately. So we will not hang on to it to, like, say, more opportune time, etc. So you may want to transfer those elsewhere and have those sold down in your own time, and then you can say transfer in the proceeds of those. So when we are transferring it, we write in the tax history as well. So please have ready your every single parcel of each ETF that you've purchased. So the price, the number of units, the date, etc. If you've participated in dividend reinvestment plans, they are purchases as well. So we need the price, the date, etc. for those. So we rebuild that cost base for you, so it's included in your ongoing tax statements from us. So that's what we need to know from you if you are looking to transfer across.
If you have a bigger portfolio balance, it makes a lot of sense to do in specie. Even though it's a bit of an admin thing, it makes a lot of sense to do in specie transfers. It's a little bit more work, but boy, it's worth it from a tax perspective. So there are some rules, like you can't change it from your name into your partner's name just because you're opening a new account. You still need to be the same beneficial owner of the shares or the ETFs. So make sure that that's all squeaky clean. The other thing is, like, if you use ShareSite or Navexa or something like that to track your portfolio anyway, you can
super easy.
Yeah, you've got it all there. And not only that, once you transfer to us, you can also just keep that going. You don't have to.
Just share with me your email address. So your ShareSite or Navexa account has a unique email address. It's like, some kind of weird letters and numbers kind of combination. Then at ShareSite or at Navexa, give that to me, and I'll put it in, so you'll get all the ongoing contract notes.
Yep. There was a bit of banter here. Claire says Luna means moon, so that's my dog's name. Good name of your dog, to be honest. And then related to that, Joe says you should name your new high growth portfolio to the moon. I've actually got a T-shirt with that on it, Joe, from COVID, so great one. Easy says, is Owen on MKR? That's why you cut your finger. Marcus and Owen, are you related? Is Owen related to the Green Arrow? I'm just catching up with all this. I don't know any of those things. I think
I've not watched them. I've not watched My Kitchen Rules for a long time. But Owen, I'm going to put it out there. I don't think you're the cook in the house.
No.
Yeah.
Unless you're looking for a very simple dish tonight, don't come around and get my cooking. But my wife Sarah, she's a wonderful cook, and she loves doing it. So I
So,
like doing
and you would not want to take away what she loves.
no, I love doing the gardening, the maintenance, all that sort of stuff, and she likes doing that. So it's yin and yang, which is a great combo. I did actually have just one quick question for the audience before we let you go. I am actually interviewing Brian Hartzer, the former CEO of Westpac, in around about 49 minutes. So if
Oh,
you have any questions that you would want to ask a bank CEO, I'm already asking him about leadership, how you'd value a bank, like what his take is on the big four right now. We're talking about how banks make money, the inner machinations, what the future holds, whether AI can do some of the heavy lifting, what data the banks can use to grow their services and technology. So those are the kind of topics. If you do have anything like that, you can drop it in the chat, or you can head over to community.rask.com.au, because Brian's obviously one of the most well-known and recognizable CEOs, banking CEOs in Australia over the past probably 2 decades. So it's going to be a real treat chatting to him for 90
you
minutes.
only now have about 45 minutes left to get those questions in.
Yeah, I've already given him my questions, so it'll be more just from anyone in the community who wants to share something. But that will be out on the Australian Investors podcast in the next 2 weeks. So you'll be able to listen to that. And the conversation with Billy from GlobalX, the one how he talks about stagflation and how to counter it in a portfolio, is really interesting. That'll be out, I think, next week. So stay tuned for the Australian Investors podcast coming up. And stay tuned to your emails, because we will be sending you updates about Luna. If you've got grandkids or kids, just make sure you act on that pretty quickly, because we're limiting the spots initially while we build it out, as well as the core updates. They'll be coming very shortly. So Mitch, thanks for taking the time to do this with me and inviting me on your Monday show.
Yeah, I need more friends on the Monday one.
You do.
The Monday one, it's where we do walkthrough. It's very specific. It's focused. We do a walkthrough of the Rask Invest platform. So anyone who's considering investing with us, a lot of people just want to see what the thing looks like. So jump on midday Monday. We'll check it out. You can ask me questions. We will fix the chat function.
Yeah.
Before that, so we'll actually see them coming up on our platform in real time. We don't have to jump across to another window to check out.
That's what I'm constantly doing.
That's what I'm doing now,
switching back and forth and looking around the place. It's because of all the different windows that are open right now. But Mitch, no sweat. So Mondays, you can catch up with Mitch. You can also book in a call on the Rask Invest website. Yes. If you want to enroll in any courses or anything like that, and you're already an investor or you're a member, for you or your family, it's free. So just send us a message and say, hey, I'd like to get access for Stephanie. She wants to do this course. It's a paid course. Can she do it for free? Absolutely. So just let us know and get in contact. We love hearing from you. So Mitch and everyone else, thank you for the good banter in the comments. Claire, Derek, Tony, everyone that